this isn't even really silver. This is the spot silver contract. Why is it so sensitive? Real collateral with zero counterparty risk. Gold is the anchor. Silver is the fuse. And revaluation, that's the reset. This is the loop. Silver signals the break, gold restores the balance, and the system, every single time, over 4,800 times, they're forced to reprice the only collateral that they cannot print. The cracks are visible. The tension is rising. Federal Reserve has documented this in their own research. Every single central bank has a gold revaluation account. The 50-day moving average crossed below the 200-day moving average, and this is the kind of break that starts collateral stress because it's telling you the most likely outcome is for the prices to continue to go down, and that was before we had that 11% drop. We are definitely coming up to a major confidence failure, and this is what it looks like. These are the indications. What are you waiting for? And of course, silver, it's always the fuse. It reacts first when confidence breaks because it's the most sensitive monetary metal. It is the secondary monetary metal. So it's the early warning signal. So why is silver the fuse and why is it so sensitive? Because it's used in 36 different areas. The physical metal itself is used in 36 different areas of the global economy. So while it's a monetary metal, it is very sensitive to what's happening in the direct economy. But there is a finite amount of it. And with all the data centers being built out and all the technology, it is a required essential metal. So it's going to be a lot more volatile. Let's take a look at this breakout because we can see the two huge cup formations that we've talked about over and over again, which are accumulation patterns. And you can see them this is spectacular. I've never seen anything quite like it as I've shown you before. And then we had the breakout. So what in the world does this breakout mean? The fuse is lit. Now look, nothing goes straight up, nothing goes straight down. You're always going to get bouncing along the way.
Most investors still treat silver like an afterthought when the market may already be treating it like a warning. As Lynette Zang points out here, silver sits at the intersection of monetary fear and industrial demand, which makes its price behavior more revealing than many traders realize. When one asset serves 36 areas of the economy, while remaining physically limited, volatility often becomes information instead of noise. The cup breakout she highlights matters because technical accumulation can sometimes appear before mainstream. Capital recognizes a larger shift in confidence. Next, Lynette Zang discusses why that volatility may be sending a deeper message than most investors expect.
I'll show you this technically, but this isn't even really silver. This is the spot silver contract. Nobody ever calls it a contract, but that's exactly what it is. And they can make as much silver, and they have, as they want to. Whereas, as I just showed you, in the physical world, there is a finite amount of it. So this is really where physical meets digital, and the physical is winning. We'll talk more about that in another video. But let's go on to gold, because really gold is the anchor, and it is the ultimate and only collateral that runs zero counterparty risk. And that's not according to me. That's according to the Bank for International Settlements, the central banker's central bank. So that's only one of the reasons why gold is the anchor, but let's take a look at how much there is of it, because again, there is a finite amount of it. It does not get used up in production. It's the primary currency metal used in 33 sectors of the global economy, the physical metal itself. But there you have it. Silver is the fuse, gold is the anchor, and take a look at the chart because it's just not as volatile. We can still see the two cup formations, but you can see how less volatile spot gold contract is. And I make a big point of that, you guys know, because again, they can create as much gold that does not nor ever will exist as they want to. But you want stable collateral?
The quiet divide between paper pricing and physical ownership is where many investors misunderstand precious metals. As Lynette Zang points out here, the quoted silver price often reflects contract exposure more than true supply, and that distinction matters when trust in financial instruments starts to weaken. Gold's role as zero counterparty collateral is not just a retail talking point, because global central banks have steadily treated it that way for decades. For long-term investors, the real issue is whether portfolio protection comes from price exposure alone or from owning an asset outside the same system, creating the risk. Next, Lynette Zang talks about how history shows those trust breaks can reshape valuations very quickly.
If you don't hold it, you don't own it. This is the most stable collateral you can ever have. Because while the loop begins with silver's ignition, the signal that confidence is breaking, and it ends with gold's revaluation, the reset of the system's collateral base. That's really what those overnight revaluations are. So let me show you, because history does it all the time. History shows that when confidence collapses, that's really what you see. Governments revalue gold overnight, not gradually. So they take something that is used in every single sector of the global economy, and they revalue it in terms of what has no intrinsic value and is only used in one place. That's that overnight revaluation. They always do it with gold because gold is the ultimate collateral, running zero counterparty risk. They don't do it politely or easily. I mean, they do it over time. Hence this face value of $20, and we're spot right now, right? Over 5,000. But that's still gradual compared to those overnight revaluations.
The phrase most investors dismiss as old-fashioned can become very relevant when trust in financial systems starts thinning out. As Lynette Zang points out here, physical possession matters because gold has historically been treated as final collateral when paper confidence begins to fracture. Governments rarely announce these shifts in advance because revaluations usually happen after markets can no longer support existing debt structures. The difference between gradual repricing and overnight adjustment is what separates a manageable correction from a systemic reset that catches portfolios unprepared. Next, Lynette Zang discusses why those historical revaluations may matter more now than many investors realize.
And that's what we have in our future when all confidence in the collateral is lost. They go to the only asset that is all collateral. And the Federal Reserve has documented this in their own research. Official reserve revaluations, the international experience. Every single central bank has a gold revaluation account, every single one. They know how this works. They know how it ends. And now, so do you. Because we've walked through every crisis. 1987, I mean, there are more. There are smaller ones. But 1987, 1998, 2008, 2012, 2022, and now. They all follow the same physics at that cracking bridge. Collateral weakens, confidence slips, and the system begins pulling itself apart from the inside. Each domino that we saw, it wasn't a new story. It was the same story repeating with bigger and bigger stakes and thinner margins because there's less and less value in this. And just like a falling bridge, once that load becomes too great, the structure doesn't slowly bend, it snaps, it collapses. And when that moment comes, the system reaches for the only material strong enough to rebuild the foundation.
What sounds extreme often becomes easier to see once you stop viewing each crisis as an isolated event. As Lynette Zang points out here, the pattern from 1987 through 2008 and even 2022 keeps returning because modern markets remain built on confidence more than durable collateral. Each rescue appears different on television, yet the underlying stress usually comes from the same shrinking margin of trust. Investors who ignore repeated policy responses may miss how institutions quietly prepare for outcomes the public is told not to consider. Next, Lynette Zang unravels why those repeated cracks may be leading toward a much larger systemic reset.
Real collateral with zero counterparty risk. Gold is the anchor. But remember, silver is the fuse. And revaluation, that's the reset. This is the loop. Silver signals the break, gold restores the balance, and the system, every single time, over 4,800 times, they're forced to reprice the only collateral that they cannot print. The cracks are visible. The tension is rising. And this next revaluation, that won't be a theory. It will be an overnight event. Well, now let's talk about what happened in 2022, because that is a very key date, since that's when, on a global basis, central banks began to raise rates yet again. In 2022, the UK gilt, so that is the UK's government bond, that market blew up. Rates spiked, collateral values collapsed, and pension funds faced margin calls. Pension funds, right? This is supposed to be for retirement. Well, if you don't know it yet, we have a huge retirement crisis in the loop, but we can't talk about that today. We'll talk about it another time. But in this case, the Bank of England had to reverse course overnight to stop a systemic failure. We get all of these clues. The question is, are we listening to them? Or because it didn't personally impact you, you go, that's okay. I don't have to worry about it. Because it's not okay. It's danger. And what happens is that domino effect. So once we get one failure, we see a whole bunch of other failures. Now, the Bank of England narrowly contained this failure, but the IMF, the International Monetary Fund, notes that the turmoil exposed vulnerabilities across the broader sector. Insurers, pension funds, leverage funds. Can you see those vulnerabilities? Because it isn't just, oh, that's over there, over here, that can never happen, which is what people always seem to think. But I'm telling you, it's a warning. Will you take heed? But I want to show you the signals and why I think that this is a real strong probability and possibility. Because in January, Microsoft gapped down 11%. That is a massive move for a mega cap. These are the stocks that have been pushing this market up. And the technicals confirm the trend. The 50-day moving average crossed below the 200-day moving average, and this is the kind of break that starts collateral stress.
Sometimes the clearest warnings come from events investors dismiss as someone else's problem. As Lynette Zang points out here, the 2022 UK pension shock showed how quickly rising rates can expose hidden leverage inside systems people assume are conservative. When central banks reverse policy overnight to stop contagion, that tells investors stability may be thinner than headlines suggest. Even large equity names showing technical weakness can matter, because collateral stress often begins in places the market once considered untouchable. Next, Lynette Zang discusses how those scattered warning signs could connect into a broader pressure point for global markets.
Because it's telling you the most likely outcome is for the prices to continue to go down. And that was before we had that 11% drop. That move spilled into other riskier assets. Bitcoin, already in a downtrend, broke below, well, I'm saying 85,000. It's below 70,000. That trigger forced liquidations. That's a textbook collateral doom loop. One asset falls, margins calls hit, forced selling spreads, and traders get forced out. This is what collateral failure looks like. The system runs out of trusted assets because it's all being guided. It's a trading market. It's not real. These stock markets, these bond markets, these crypto markets, they are not real. And when the confidence in those collateral break, everything built on top of it, everything begins to unwind. Why is gold and silver so volatile? Because of bets, not because of the sound money, not because of the physical metal. Here's the data. Manufacturing business confidence is below zero. Consumer sentiment is barely above the lowest level ever recorded.
Price declines rarely stay isolated once leverage starts exposing what confidence was hiding underneath. As Lynette Zang points out here, when Bitcoin broke from 85,000 towards 70,000, it reflected more than speculation because forced selling often spreads into every crowded trade nearby. Investors sometimes mistake volatility in gold and silver as weakness when much of that movement comes from liquidation pressure inside the broader system. Manufacturing confidence below zero, while consumer sentiment hovers near record lows, suggests the economic foundation is weaker than major indexes still imply. Next, Lynette Zang discusses how that same stress eventually moves from markets into ordinary retirement savings.
This was the second derivative trading collateral failure. So let's go to what happened to the normal person, to your 401k, because I had a client that was in the reserve primary fund when it broke the buck. What does that mean? That means we've been taught that money markets are like savings account. You put $1 in, you get $1 out. But that's not what happened in 2008 when the underlying assets, the collateral in those money markets declined below $1. And so what did they do? They just eliminated your ability to get your money out. That's all. Capital incarceration is really what that is, but people don't realize it. And this was supposed to be the safest cash equivalent asset in the world, but it started a domino effect that went from one asset to another to another. That's when confidence collapses instantly. And that's why they had to halt distributions and raise the limits on the FDIC insurance from $100,000 to $250,000 because that confidence evaporated. So this is the stage 3 of that doom loop. Borrowers can't meet the margin calls. And so that forces more selling. And frankly, this is the moment when margin calls go unmet and lenders then seize assets.
The real danger often begins when investors discover their safest assets were never as liquid as advertised. As Lynette Zang points out here, the 2008 reserve primary fund collapse exposed how quickly a cash equivalent can become inaccessible once underlying collateral loses value. Many retirement savers still assume money markets behave like bank deposits, even though market structure says otherwise under stress. The FDIC insurance increase from 100,000 to 250,000 was not reassurance alone, because it was also an emergency response to evaporating trust. Next, Lynette Zang talks about why missed margin calls can turn private losses into wider systemic pressure.
Borrowers liquidate whatever they can. People always wonder why, well, they call it gold. It's really the spot gold contract falls when the rest of the market is falling. It's because they've got to meet margin calls and they've got to sell what the market will buy. Selling pressure cascades across markets, and that's the domino moment. Each forced sale knocks over the next asset class in the next institution, in the next market. So here we are, because that takes us right to the sovereign debt crisis, which is still an extension of what happened in 2008. Do you remember that? 2011, 2012, wasn't that long ago. But that's when Europe's sovereign debt crisis followed the same exact patterns. Bond values fell, collateral failed, and governments had to bail out banks that, quite honestly, were turning around and bailing out the governments in this big collateral doom loop. And for the first time, we saw the next stage, bail-ins, where depositors, not taxpayers, take the hit, though I dare say it will be a bit of both in here. That leads us to bail-ins. Because in every crisis, the financial system fractures like a stressed suspension bridge.
What looks irrational in goal often makes sense once liquidity becomes more important than conviction. As Lynette Zang points out here, investors sell what they can, not always what they want, when margin pressure starts forcing collateral into the market. The 2011 and 2012 European debt crisis showed that sovereign bonds can lose their safe haven status faster than most portfolios are built to handle. Bail-ins changed the conversation, because depositors suddenly became part of the rescue structure instead of being protected from it. Next, Lynette Zang unravels how insiders usually recognize those fractures long before the public does.
But here's the part that most people, frankly, they never see it. The insiders are standing near the exit, and the public is standing on the weakest part of the span. In Cyprus, that's where they did that first bail-in. Those big European banks, that black line, well, those were mostly German and French banks, and they very quietly stepped off the bridge before the cable snapped. But local families, small businesses, and retirees, well, their deposits are what's called sticky. So they were still out on the deck when the bail-in hit. They absorbed the shock because they were the last ones left standing on that failing structure. If they had their wealth in their hands in gold and silver outside of the system, they would have been just fine. But that's actually not what happened. It's tested. And this is the pattern. The insiders feel the vibration first. They know about it. They know what they're doing. And they move to safety. The public feels it last, when it's too late, when they see it. And they pay the price.
Markets often look fair only until you study who quietly leaves before the damage becomes public. As Lynette Zang points out here, the Cyprus bail-in revealed that institutional money moved away while ordinary depositors remained trapped inside the system. Sticky deposits sound technical, but for families and retirees, that usually means their savings become the easiest capital for authorities to reach. History keeps showing that information reaches large players first, while retail investors receive reassurance after the risk has already shifted.